Hey guys, I wanted to talk with you all today about liquidity and why it's so important when trading cryptocurrencies because there are a lot of people out there that have maybe misunderstandings about how the market works and what they're capable of doing with some of these low market cap coins. Like, let's take Pepe for instance this week. And I'm not trying to take anything away from Pepe, okay? It has $100 million market cap in a week, which is phenomenal. Nobody else has done anything close to that. So I'm not trying to take anything away from it. But its liquidity on Uniswap is currently only $2.5 million, meaning that if somebody were to take $1 million worth of Pepe and try to sell it on Uniswap, they wouldn't be able to because one, it would take the price and cut it nearly in half. So the price would be nowhere near what they were trying to sell it for. And then if you had, let's say, 1,000 people try to sell $100 worth of Pepe all at the same time, they wouldn't be able to get anywhere near the current value. And that's kind of how liquidity works, right? Because without liquidity, there's nothing to sell into. The higher the liquidity, the more people can sell into that asset and the price won't budge one way or the other. So you want to have as much liquidity as possible. And that's also why a lot of these exchanges like FTX and others have gotten into hot water because they didn't have liquidity on the exchange for people to pull their funds out. So let's say you put your money on an exchange in Bitcoin, Ethereum, or a stable coin, or even in US dollars, and you trade for another digital asset, and then you try to remove that from the exchange. If there's not liquidity in that asset, then you can't remove your funds. And that's exactly what happened with FTX. There wasn't enough liquidity for people to remove their funds in whatever assets they were holding, whether that was in Bitcoin, Ethereum, or other digital assets. There just wasn't liquidity there for them to do so. And a lot of people heard rumors about them being insolvent, and so they all rushed to remove their funds at once, and they went insolvent. So it was kind of like a self-fulfilling prophecy, but at the same time, they really didn't have enough funds to back everybody up, meaning that they didn't have the liquidity there. And that's why it's so important in the cryptocurrency market when we're talking about things. Liquidity is so very important. It's one of the most important aspects of any exchange. You have to be diligent in where you're trading and how much you're trading. So if you buy, let's say, token A over here that has, only 100 grand in liquidity, and the value of that token A goes up to, let's say $10 million, but there's only still $200,000 in liquidity, but you own $1 million worth of that token, you don't really own that much, because if you were to try and sell into that $200,000 worth of liquidity, you wouldn't be able to. There's just not enough available there for you to sell into. And so, again, you have to be very diligent on what you're looking at and what you're speculating on. There are going to be a lot of people that take this Pepe pump and try to recreate it in other tokens, and they're going to be these low cap coins. They are going to promise a lot of things, and they are going to underdeliver, but people are still going to rush into these things and pump them. But be very careful, because you could be their exit liquidity. So let's say the liquidity does start going up on these tokens, and the ride is smooth sailing for a little while. Well, after a little while, that could change really fast and drastically if one little piece of FUD comes out and everybody just starts dumping at the same time. That liquidity that used to be there could dry up extremely fast, and you would lose everything on that trade. So be very diligent, be very careful out there in the crypto market, because sometimes it can be the Wild West. Now, I'm not saying that to say that there's not enough regulation out there. There is plenty of regulation. It's just people in whatever market you trade in are going to try and take advantage of you. And, we saw it with the Nigerian princes when email was first coming out. We saw it in the .com bubble. People are always going to do whatever they can to try and take advantage of others. So don't think that it's, all bad. There are good things out there, and there are amazing trades that you can make, but you just have to be able to focus on what is and what is not a good trade. So hopefully this helps a little bit explaining why liquidity is so important. If you enjoyed today's video, please be sure to hit that like button. And if you haven't already subscribed, please do so. It really helps my channel grow. But that's going to be it for this one. Crypto Clay out.